Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So an important consideration here with respect to these in-the-money option contracts, or in fact the categorization of any of these options and its relationship to the underlying security, has to do with the options delta. Now, there are a number of different variables, as I mentioned, that influence the price of an option contract, but the one that is most correlated with the option contract in its relation to the underlying security is the option delta. So that is the Greek name for the influence that the underlying pair value is going to have on the actual premium itself. So one thing that we have to recognize is that as the option generates an intrinsic value, the delta increases. Now, the delta is the mathematical measure used to show the rate of change in an option price relative to the change in price in the underlying security. So, for example, we'll move forward. We'll take a look at an example here. Let's say I'm looking at a pair value that is sitting around the 50-point mark, and I'm looking at an option strike of 50, which would be considered, of course, an at-the-money option contract. Now, we're going to consider just 30 days until expiration, and we're going to look at the option premium being worth about 2.32. Now, that particular delta is going to be listed in and around the 0.50 mark. So one sort of general rule of thumb is that an at-the-money option contract is going to sit around the 0.50 mark. So in this case, in this example, the delta is listed at 0.53. So what this is really suggesting is that as the underlying pair moves 1 point, the option contract, without considering any of the other factors, is going to move about 53 cents. So in other words, if the pair value goes up to 51, with the option strike price at 50, the option premium should move from $2.32 to $2.85 or 2.85. So you can see that 1 point increase in the pair has actually influenced that option contract to increase the amount of its delta. And what happens is the more that underlying security increases, the higher the delta becomes, and the more influence that underlying has on the price of the option contract. And it actually works in the same respect for the put option. So, for example, it works in the opposite way as well. So, for example, if the pair value drops to 49 or drops 1 point, if the option strike price is sitting around the 50, sitting at 50, then we would subtract 53 cents from the option premium, and we would see that the option price would be reduced down to 1.79. Now, what's interesting, what happens in the event that the pair value starts to move against us, is that the delta actually decreases. So, for example, if we start off with a delta of 0.53 and then the underlying security drops that 1 point, well, the initial drop is going to have an impact of, say, 0.53. But after that drop takes place, then each consecutive dollar drop is actually going to have less and less of an influence because the delta is actually lowering. So it's just an interesting sort of observation as these kinds of positions move against us. And that's a consideration, of course, when we utilize a deep-in-the-money option contract, when we're trying to measure the risk exposure that we have, is that we may start out with a risk exposure based on a high delta, but as the security moves against us, the delta begins to drop, and the influence of that underlying contract, or of the underlying pair value, begins to lower as well. So a couple of characteristics that we need to be aware of. As a call option becomes deeper in the money, the delta will approach 1. So what that means, as I mentioned earlier on, is that the deeper in the money our option contract goes, the more closely it's going to reflect a move in that underlying pair value. Now, a call option will always have a positive delta, okay, and a put option, as I've indicated in this point down here, will always have a negative delta. Okay, so that as the pair value as a put option becomes deeper in the money, that delta will approach the negative 1. Now, once again, just as a quick reminder, a delta of 1 means that the option price will increase 1 point for every 1 point increase in the underlying pair value. Okay, and another point of consideration is that a put option will always have a negative delta. So let's take an example here. Now, I utilized just an observation that I was making on the YUK the other day. This is an actual daily chart of the U.S. versus the Japanese yen, as reflected here in a chart of the YUK. And so once again, just recognize that through any standard charting software as well, you could call up a quote for the YUK, and it will actually give you the chart that you can utilize to actually trade your view. So there's a couple of observations, as I said, that I just made as a point of interest. First of all, we can see down here what I've actually applied to the chart is just an 8-bar and a 21-bar moving average. And the idea from a technical perspective, again, I don't want to make this a lesson in technical analysis, but if we see our 8-bar moving average cross below our 21-bar moving average, then that tends to reflect a downtrend. And we could see that for all intents and purposes, the U.S. dollar has been losing significant ground against the Japanese yen here. And what we can see here over the course of the last couple of months is that there's been quite a bit of consolidation up until the unfortunate events that unfolded several weeks ago. But there's been quite a bit of consolidation that's taken place within that particular pair. But just as of the last couple of days, particularly when the Bank of Japan intervened with their monetary policy, we actually saw a depreciation in the yen, and the U.S. dollar started to gain some strength. Well, let's take a look at what we would refer to as a resistance level here. And the idea is that if we see the pair start to break above that resistance level, then we might begin to expect a possible move higher in this particular pair. So again, just an example of how we might use a price chart to trade our directional view. So what happens is now we have to decide, well, what is the best way to participate in this particular opportunity on the YUK, recognizing that we want to create a scenario that meets with our own personal risk and trade objectives. So what I did, of course, just illustrating my directional view here with that break of the 84 level. But what I did is I just took a look yesterday at some different potential choices that we can make with respect to the options that we're trading when the YUK was sitting around that 84 level. So the consideration here is that we're bullish on the YUK, which is reflecting the U.S. dollar versus the Japanese yen, and that the current pair value is sitting at 84, and we're looking at December expiration. So we're gonna give ourselves quite a bit of time in order to participate. And one thing we always have to remember is that when we give ourselves time, we're going to have to pay for that particular time. So the more time we want to give ourselves, the more it's in fact going to cost us. So if we take a look at a couple of different considerations here, and again, these are call options on the YUK, we can see that an out-of-the-money option contract, so there's your 90-strike call option, which is about $6 out of the money, has an asking price of $1.74, which is reflecting 0 intrinsic value, a time value of 1.74. So, of course, because there's no intrinsic value, the value of that option contract is all time, and a delta of around 0.30. Okay, I'm just getting, somebody's just suggesting that they can't see anything, and I don't want to go any further if we've lost a video feed here, but maybe a confirmation from folks that letting me know that you can see anything. Yeah, you know what, Frank, it could be that you've just closed the window by mistake. Just make sure you click on the little tab that says webinar versus info or et cetera, and that should get you back into the loop here, hopefully. So anyways, so we're looking at a far out of the money option contract that is asking $1.74. So realistically, if our maximum risk exposure, if the pair value does nothing between now and the third Friday of December, is that we're going to risk $1.74, and our delta is 0.30. So in other words, if the underlying pair moves 1 point in our favor, then ultimately we're going to see a 30-point or 30-cent appreciation in the option contract that we've purchased. So from a percentage rate of return based on our capital outlay, fairly attractive if the pair value moves in our favor very quickly. Now, if we go to our at-the-money option contract, which is typically our middle-of-the-road option contract, we see that the ask price is, in fact, $4.10. There's still 0 intrinsic value, which means that the premium that we're looking at purchasing here is made up entirely of time. Now, this gives us a delta of 0.54. So again, now that we're at the money, you can see that the listed delta of that particular option contract at the time was 0.54. So that falls in line with that general rule of thumb that I suggested with respect to an at-the-money option contract having a delta of around 0.50, give or take, depending on what contract you're looking at or what security you're looking at. So, but what I want you to notice here is what we're doing now is we're going into the money here. So we're looking at the 80 strike option contracts, which are essentially $4 in the money. Now we're going to have to pay a higher premium, but what we've done here is we bought $4 worth of intrinsic value, which has mitigated the time component down to $2.70. So if we compare our capital allocation to time versus the at-the-money to the in-the-money here, we can see that the at-the-money option contract, we're putting out $4.10 in time for a delta of 0.54. But if we go and we put up that extra $4, we're actually only putting up $2.70 in time, and we're achieving a delta of 0.70. So in fact, a $1 point move in that underlying security, instead of only netting us out 0.54 cents, is going to net us out 0.70 cents. Now recognize that at the on expiration, our maximum risk is if the underlying does nothing, is going to be the time component, and we're going to talk about maximum risk as in the next chart here. But the idea is that by just going that one more step into the money, yes, we're putting up more capital, but we've now offset the influence of time, and we've actually increased our ability to profit based on that 1 point move in the underlying security. Now, going even deeper into the money, what you'll notice here is we're putting up $10.70, which, yes, is getting a little bit more expensive, but what I always say is that we have control over how much we risk. So just because we're putting up $10.70 doesn't mean we're going to risk that entire amount. But what we can notice here is that we're buying $9 in time premium, $9 in intrinsic. We're paying $1.70 in time. So for the same amount of time premium, actually less time premium, we're actually achieving a delta of 0.83. So the difference is that we're putting up more capital, but less of that is actually allocated to time. So we in the event that the underlying security does nothing, we're risking less from a time component, but we're making more money on a dollar-for-dollar basis when that underlying pair value actually moves in our favor. So let's take a look at just, obviously for example purposes, what I wanted to do was I wanted to just take a sort of just two sort of very clean examples here. One of deep in the money option contract. So we're looking at the underlying pair, the YUK trading at 84, and a 75 strike call option, which is deep in the money, versus an 84 strike call option, which is at the money. Now, what I want to just show here is that the premium that we're paying for the deep in the money option contract is definitely higher than the at the money option contract. So here we're putting up $10.70 for our in the money versus $4.15 for our at the money. But a very important consideration is that $9 of that is being put towards intrinsic value. So kind of look at that as almost like a down payment on the value of that underlying pair, in the sense that we're putting up a portion of the value of that option contract to participate, versus only buying time, because you can see there's no intrinsic value with that 84 strike option contract. Now, the important consideration is that the 75 strike option contract is really only worth $1.70 in time versus $4.15 in time. What also is I believe an extremely important factor is that we basically have a break-even point for that deep in the money call option of 85.70. So realistically, that pair, the CDD, only has to move 1.70 units, I'll call it, in our favor before we start making money. And as soon as it starts trading above that, we are actually profiting between now and any time between now and the third Friday of December. We're actually making a profit. So in other words, if we wanted to sit back and hold this position for the entire time, as long as the pair is trading above 85.70, we know that we're going to be profiting. So in the case of let's say the pair staying the same between now and the expiration, we know that the maximum risk exposure is going to be our time value, and that we're risking really only the $1.70, because that we know is going to expire worthless. So on the third Friday of December, if the pair has not done anything at all, is settling at 84, we're going to get $9 per contract back, only risking that $1.70. If the pair actually goes up in value, we actually will be able to settle out that position at $14, because that's going to be the intrinsic value of the option contract when we take an 89 point pair value and subtract the 75 strike price. It's going to be worth $14. Now, if the pair drops drops $5 down to 79, well, the pair is actually, or the option contract is going to be worth $4. So we'll have in fact lost approximately the $5.70. But the idea is that there still will be a value to that premium. Now, if we compare the 84 strike, once again, if the underlying security is at 84 on the third Friday of December, well, ultimately that option contract is going to expire worthless, and we'll have lost our entire premium. If the pair goes up to 89, well, it's only going to be worth $5. So remember, we put up $4.15, but we're going to have to. We're only going to be able to offset that pair for the $5, because remember, we have a break-even that we have to consider. Our break-even point is 88.15. So the pair has to move that much greater in order to compensate for that time value component that we've actually had to allocate. Now, of course, if the pair drops $5, we're only going to receive, we're not going to receive anything for that premium. It's going to expire worthless. So just to kind of put that into the perspective of our price chart, at this point, if we're looking at the current value of the YUK sitting at 84, if we elected to buy those deep in the money option contracts right now, well, we're going to put up more capital. There's no question about that. But because we're only paying a very small component in time, as soon as the pair moves above our break-even point, which is sitting at 85.70, we're actually going to be able to make a profit. So as long as the pair between the on the third Friday of December settles above this 85.70 mark, we're actually going to make a profit. Whereas if we consider that 84 strike and the fact that we're actually paying that $4.15 in time, you'll see that the pair actually has to be all the way up here above that $88 mark in order for us to profit. So our break-even point, although we're putting up more capital to utilize that deep in the money call option, our break-even point on this particular transaction is actually lower with that deep in the money call. So this actually gives us a higher probability that we're going to profit. So we're putting up a greater amount of capital, but we're increasing our probabilities of being able to profit by lowering our break-even point based on where the underlying is trading at presently.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.